Welcome. Thank you for joining me tonight for this live webinar titled Multifamily Real Estate, a Roadmap to the Present and Future. I know we have some familiar faces on here tonight, so welcome. We have some past investors, current investors, so very happy to have you guys here. So what we're going to cover tonight is the state of the multifamily market, where we are today and how we got here, challenges and opportunities, predictions for the future, and a Q&A session at the end. There should be a chat box on your screen. So if you come up with any questions during the presentation, feel free to type those in and I'll do my best to answer them. If for some reason that's not working, we can connect after and I'll do my best to answer any questions you may have. So many of you have probably seen headlines such as this one from many of the business news focused outlets calling for the impending peril of commercial real estate and multifamily real estate. And we've read those headlines too. And we agree that there are several economic factors converging in the real estate sector. But for those waiting for the headlines to improve, we'd like to offer our viewpoint for consideration. So before we dive in, just want to introduce who we are. First off, I'm Michael Schmidt, principal at Crown Bay Group, and my partner is Steve Firestone. Crown Bay Group was founded about 10 years ago. Since then, we've acquired almost 4,000 units with a total value of approximately $325 million. We've completed a little over 20 deals, 16 of which have gone full cycle. We're an owner-operator that specializes in workforce housing properties, and those are Class B and C properties, primarily in Atlanta and select Southeast markets. These properties, if you're not familiar with Class B and C properties, they're properties that are affordable to middle income and lower middle income Americans. We started our own management company in 2017 after we were not satisfied with the performance of third-party management companies. And we noticed an immediate turnaround in our properties. And our management company is led by an industry veteran with 40 years experience. She's done everything from Class A, B, C, D, E, F, G, get the hell out of their properties faster than your feet you can take you. So, I mean, she's done it all. And if you think about property management companies, specifically third-party management companies, they're really in the business of growing their business. And they do that by increasing revenue and getting more properties under management. But there's not really a true alignment of interest, which is what our experience was. And so we have a better alignment of interest by forming our own management company. And it really is our secret sauce. And all of our properties are managed by Crown Bay Management. And we don't do any third-party management assignments. So what we buy, I mentioned Class B and C properties. Primarily, I would say 90%, 95% in Atlanta. Steve and I both live in Atlanta, so we know the market really well and we have good connections here. So anytime we venture out, the deal finds us here back in Atlanta and we coming back. So Atlanta is a great spot for us. The properties are typically 1970 to early 1990s vintage, 100 plus units, typically 100 to 300 units. And the reason why we have that minimum is because you get better economies of scale at 100 units, meaning that the property is large enough and there's enough revenue to support on-site management. So at the minimum, with 100 units, you can have a full-time property manager and maintenance tech. We also buy almost all of our deals off market. I mentioned we have really good contacts that some are probably on this call that that we've formed relationships with over the years, and we're known as being honest, and we close deals, and so keep coming back to us, and we like to buy deals off market because we want to get a discount to market value, and that creates an equity cushion. That's our number one rule, is we want to buy right. And then we look for properties that have multiple value add components to force appreciation. And so what I mean by that is, one of the first things we look at is the property being managed effectively. And so we like taking over properties that have poor management, and seemingly every property that we take over, we see that, and that's easy for us to do because it doesn't cost much money, and so we're able to turn those properties around. We also look at things like value add capex spending, so whether it be amenities, the exteriors, if there's deferred maintenance, and then also obviously interior value adds. So here's some past deals that I'll just run through pretty quickly to give a flavor on what some of the properties look like that we buy and performance. The first two deals, 250 units and 240 units. Parkside Crossing, we held that for 3 years. It was a 90% return to investors, or 31% average annual return. Hairston Woods, we held that one for 18 months, and it generated a 41% return to investors, or 27% per year. South Lake and Vineyard, that was purchased. That was 2 properties purchased at the same time. All of these were in Metro Atlanta. That one totaled 454 units, purchased for $24 million, sold for $35.4 million 3 years later, and that was a 77% return and a 25% average annual return. Here's 2 other deals. Ash Grove, 92 unit Cardinal property. That was a 55% return, 21% per year. Cascade Oaks, 113 unit deal. That was a 65% return, 35% average annual return. These 2 deals are what we call the COVID deals. We bought these during the COVID lockdowns. There was a window of opportunity to buy from, if there were nervous sellers. There weren't a ton, but there were out there. And these deals were local. We were able to go look at them and strike a deal when others were on the sidelines. So these were really good deals. Pines of South Lake, that was a 93 unit deal. And the intention was to hold these for 3 to 5 years. But what ended up happening is, after COVID and rent growth spiked, the market got flooded with new buyers, and we were getting unsolicited offers, and it was just crazy. So we ended up selling Pines of South Lake about 14 months later, and it was a 65% total return, 56% annualized. And then 4375, I really like this property a lot. It was a 260 unit deal. We paid $20 million for it in October of 2020, and we sold it about 14 or 15 months later for $33.3 million for 100% return in 15 months. So that was an 80% average annual return. And we actually sold that property for close to $37 million, but I put the net price in there because we assumed the loan, and there was a yield maintenance penalty, but it was worth paying it because the return on it was so strong. At the end of 2021 and early 22, we actually sold off all the properties that we had, which turned out to be pretty fortuitous timing. The market was just extremely frothy at that time, and we were getting prices for our assets that we didn't think we would get to we thought we'd get there maybe 3, 4, 5 years, and we were getting them after a year and a half. So we ended up selling everything off, and we sort of tightened our criteria, and it was just a pretty wild time. And I'll get into this a little bit later in the presentation. Just really cheap debt, tons of buyers in the market. So it was really tough to find deals. But we ended up finding Netherly Park. It's a tax credit deal, 294 units. We paid 31.1 million for that. In the tax credit deal, what that means is there's rent restrictions on the property, and they're on it for 15 years. We bought it at the end of the 15 years. And so the business plan is to take that property into a decontrol period. And then after you get out of that decontrol period, the rent restrictions are lifted and you can charge market rents. So we're about 4 months away from those rent restrictions being lifted. And the value is probably in the 42 to 45, $46 million range, for next year when we go to refinance or sell it. We also bought another tax credit property that's not sold here or shown here. That's 284 units. And then Bullock and Dodson, that was a off-market deal. We got really lucky to get this one. 203 units, 2 properties down the street from each other. Another Metro Atlanta deal. We paid 20 million for it, 20.4, and the value today is probably around 30 million. So that's going to be another really, really good deal. And I think the point I'll add is I wanted to show the track record to show the type of properties we bought, but it's not purely a case of a rising market. And we've learned a lot of strategies over the years to force appreciation. And those current examples were bought during 2021, pretty much at the height of the market, and we're still doing really well on those. So before we get into the state of the market, I think it's important to first look at the Fed rate hike timeline. You can see here from March of 2022 to September of 2023, you can see in this chart the speed and magnitude of these rate hikes going from near zero to around 5.5% target rate. And the reason why I show this is because the Fed's actions have a direct impact on financing multifamily projects and also refinancing multifamily projects. So this is really the story of what has been going on. And if you were trying to buy a deal between March and September, the debt terms were changing by the day. So it was very, very difficult to value properties. And as a result, transaction volume just plummeted. I think we're probably close to the end of the rate hike cycle. So that's providing more certainty. But I mean, this is really the story for the last 18 months. So let's get into the state of the market. The market is correcting. There's a lot of repricing of assets going on, primarily because of the changing in the debt markets. Buyers and sellers, for the most part, don't agree on price. And when there is a gap, this bid-ask spread, that you often hear, then transactions just don't occur, and there's less price discovery. So let's take a closer look at that, primarily the debt terms, and we'll talk about fundamentals. So I've divided this into 2 columns, what I would call the previous cycle, which I'm saying ended in March 2022, and then where we are today from March 2022 to where we are. When you finance or when you buy a multifamily property, it's obviously a combination of debt and equity. And then on the debt front, it really falls into 2 buckets. You either get permanent financing or you get bridge financing. And then within those, you can do fixed or floating. So permanent financing is for properties that are stabilized, 90% plus occupied, and 18, 24 months ago, you could get a fixed rate loan for up to 80% LTV. So that means if it's a $10 million property, you could get an $8 million loan. And the rates were in the 3s. Today, fixed rate loan, the leverage is 50 to 65%. So $10 million property, you get a $5 million loan, at best, maybe a $6.5 million loan. and your rates are in the high fives to mid sixes. So a pretty drastic difference. I'll also note that in the permanent financing bucket, that's primarily the agencies, Fannie Mae and Freddie Mac, that are providing that liquidity, which is unique to multifamily. Other asset classes have to rely on the banks, and that can be a bit of a dicey scenario, like in the office space. But multifamily have these quasi-governmental agencies that want to provide liquidity to the market because they care about housing. So pretty big difference on the fixed front. Floating rates, you get up to 80% leverage on a floating rate loan with a starting rate in the high twos. Today, Fannie Mae just doesn't really want to do them, and Freddie Mac's rate is, last I heard about, is 7.65%. So, big increase. On the bridge front, 24 months ago, it was mostly floating, and you could do up to 80% loan to cost. So that's, $8 million loan on the $10 million property plus the CapEx money. So much more highly leveraged, and the starting rate was in the high twos to threes. Today, you're seeing more fixed, and you'll see floating. Leverage is a little bit less. That's because really they don't care as much about the current property performance. They're looking at your business plan and future projections, what you're going to do with the property. And obviously these are properties that don't qualify for permanent financing. The goal is to get the bridge debt on it and then to turn around the property and get permanent financing. So leverage is still pretty strong, but the rates today are in the 8 to 11% range. So obviously very high. And then the last point on the bridge debt, and really this applies for all floating rate loans, is that rate cap pricing. So what rate caps are is essentially a way to hedge your interest rate risk. And most of the lenders, if you do a floating rate loan with one of the agencies, they require them. Most bridge lenders do, but some don't. So let's say you bought a deal 2 years ago on a floating rate loan, bridge loan at 2.8%. Well, you might buy an interest rate cap that maxes your exposure at 5.8%. And so what that means is if the rate goes over 5.8%, that is, you don't have any additional risk over that 5.8. A counterparty sends you the excess funds. And 24 months ago, rate caps pricing was nominal. It's a cost that you pay at closing. Today, and really for the last 12 months, they're very expensive. So if you bought a deal and you bought a 3-year rate cap, meaning you had that risk protected for 3 years, let's say it costs $60,000. Today, a rate cap costs probably $600,000 for the same deal. So that's been another, big hurdle to financing on floating rate loans if you're going to go bridge. So you can see big differences in the debt world in the last 24 months. Now I'll talk a little bit about fundamentals. Prior to March 2022, we really had strong rent growth, and I'm talking nationally. Every market's a little bit different, obviously, but strong rent growth. And coming out of COVID, we had back-to-back years of double-digit rent growth. Limited new construction, but there were a lot of starts coming online, and we had low vacancy. In the last 18 months, we had slightly negative rent growth nationally in the first half of 2022, and then it's been positive, albeit, pretty muted rent growth. And there's been a significant amount of new supply added, primarily in the Class A luxury space, and there's more that's going to be coming online for the remainder of the year. So vacancy is ticked up, but it's still quite low. So you can see fundamentals were a lot stronger. They're not bad right now, but they're moving more in line with, I would say, historicals. And the prior market was a seller's market, no doubt about it. This market, volume's down for transaction activity 60% plus for the reasons that I've stated. And it's really more of a neutral market to a buyer's market. So in summary, leverage is lower. This means more equity or down payment is needed. So all else being equal, returns are lower. Interest rates have essentially doubled. That means there's less cash flow available because more cash flow is going to pay debt service. So all else being equal, returns are lower. So to put this in perspective, a hypothetical example, if everybody on this call got together a couple of years ago and we bought a property and the equity raise was $1 million, and we all pooled our funds together to buy this property. And we held it for 2 years, and we looked back to see what the total profit was, and we totaled up all the cash flow and the back end profit, and it was $500,000. So you had 500,000 divided by the equity raise, which is $1 million. So it was a 50% total return. If you did that same deal today with just leverage being lower, the property, just assume the property operates the exact same. Nothing's changed about it, just the leverage is lower. That means that the equity required to purchase the property is not $1 million, but let's say it's $1.5 million. Your profit was still $500,000, but now you're dividing that 500,000 by $1.5 million. So the total return that we all have is 33%. Property operated the same. It was just lower leverage. Now you throw in interest rates being higher. So let's say instead of $500,000, it's $400,000. So it's $400,000 divided by the 1.5 million. Now you're down to a 27% return. Property operated the same exact thing. This is just debt that's changed. So that's what I'm trying to say here. With leverage being lower and interest rates being higher, that's the effect it has. So the question is, we all get together and we say, is 27% enough? If it is, you can buy the property. But if you want 50%, the only thing that can change is the purchase price. So you have to lower the purchase price. And if the price isn't lowered, then the deal doesn't get done. So that's kind of what's been going on if we use just a hypothetical example. So then the question is, when will sellers lower their price? Well, we think over the next 12 to 18 months, there's going to be some buying opportunities, mainly because that bid-ask spread has been shrinking, especially with the Fed kind of at the tail end of their rate hikes here. And we think the properties purchased at peak pricing in the last couple of years with short-term floating rate bridge loans are going to be opportunities, because some of those owners will not be able to refinance. So if you took on a property and a $10 million property and you bought it with $8 million of debt, you go to refi a couple years later. If the property is still worth 10 million and leverage is only 55 to 65%, you can only get a $5.5 or $6.5 million loan, but you owe 8. So you have to come to the table with money or you have to sell. So we think that is going to be happening. I mean, we're already seeing it. We've seen much more deal flow with some groups kind of quietly shopping off market some of these deals, and they've been discounted to account for it. In our opinion, not enough, but I think that trend will continue over the next 12 to 18 months. And then I also think that all properties that are sold within the next 12 to 18 months will trade at some level of discount to the previous cycle in that kind of short to medium term. Some will be distressed and others won't be. But even if it's not distressed, it doesn't mean it's not a good deal. It can still be a good deal. And the last point is just that, you have to be prepared to take action when such opportunities arise. So is it a good time to buy? We get this question a lot. If you asked me probably 4 months ago, I would say no. But we do think that the buying window is starting to open. We're aggressively hunting for deals. but that doesn't mean that we're aggressively underwriting deals. We're still maintaining realistic projections, but we are looking for those deals. It's important to always keep a pulse on the market. I think there are good deals in every market cycle, and that if a deal makes sense today with current debt terms and rates, it's more than likely going to outperform. And the reason I say that is because when you buy a property, it's a 3, 4, 5 year hold typically for us. And if the deal makes sense during that time period using conservative assumptions and a conservative exit cap, and you sell 3, 4, 5 years down the road, more than likely debt terms are going to be better, meaning there's going to be better leverage. Rates could be even a little bit lower. Maybe they're a lot lower. There's going to be better market optimism, which is going to drive pricing. So there's a really good chance you outperform. But even if you don't, you underwrote it conservatively, so you still feel good about your numbers. Another reason why we think it's a pretty good time to look at deals and consider buying is because I showed that slide with the Fed rate hikes. So much uncertainty for so long. We're probably done raising rates. I think the market is pricing in, maybe another small rate hike in December, maybe a 50% chance. But the point is there's more certainty in the market, and your debt terms aren't going to change on you week by week. So that's another positive. And then lastly, I put here, remember that when the Fed does cut rates, when everybody's waiting for the headlines to improve, the Fed cuts rates, market optimism goes up. So that means more buyers are going to enter the market, prices will increase, cap rates go lower, and it becomes more difficult to find great deals. So I do really think that there is going to be a window here for the next 12, 18, 24 months to find some pretty good deals. And you want to get ahead of the pack mentality. Okay, so the next two slides, I'm going to talk about tailwinds for multifamily and headwinds for multifamily. So this is looking, present day and out for the next 5 years. Tailwinds, so positive trends for multifamily. The first is that many of the planned projects, so new apartment construction, those projects will not get built. So that means that there's less supply coming after the current tranche. And this is really more in the Class A luxury space. And they're not getting built mainly because there's less financing available, interest rates have gone up, and cap rates have gone up. The second one is there's a shortage of workforce housing. This is our space. And really, this has been a story for over a decade now. It's just not financially feasible to build it in these quasi infill locations. So that's another positive for future rent growth. And the last one is single family home affordability. I know when rates started increasing that there were a lot of people saying that there was going to be the bubble was going to burst in single family, and it just has not happened. Prices continue to go up, and I think that is mainly because some 70% of homeowners are locked into rates that are sub 4%, and there's 40% homeowners don't even have a mortgage, so they're staying put, and there's record low inventory. And so with steady demand, you can't get a bubble to burst when there's no inventory and there's steady demand. And so it is prices have gone up, and it just becomes even more unaffordable to purchase a home if you're a first-time home buyer, or if you're just a middle income American. And so what's going to end up happening, in my opinion, is that these renters are going to be renting for longer. And so that's positive for multifamily demand and rent growth going forward. Headwinds for multifamily. So the first one is expense inflation, and I put here insurance because I think that's the main one. I read a white paper that our insurance broker sent us because we had an upcoming renewal at a property, and it's just, year after year these increases are crazy. And in there was the author wrote that 2023 is to property insurance as 2008 was to banking, and I was not surprised to see that based on the increases, but it is. You're seeing insurance costs are increasing 15 to 25% per year. Doesn't matter if anything happened at your property or not. But it obviously depends on the market. But the coastal markets are getting crushed in Texas and Florida. I put 50% plus in these markets. I've heard 100%. And the question is, why is that happening? Yes, it's natural disasters. It is crime, it's litigation, but it's really just the concept of return on capital. And the capital that flows into the insurance industry is looking for a good return with relatively low risk. And what's happened over the last couple of years is they've gotten crushed. And so that capital is going into other alternative investments looking to find less risk and a better return. So there's less capital available to the property insurance market, and that capital is more expensive. So it's getting passed on to commercial real estate owners. In the same white paper, it was hoping, they were hoping for more stabilization in 2024, but this has really been a trend for the last 5 years, I would say. But it's gone up significantly in the past 2 years. So this is something that we're mindful of. Obviously, if you own a property during this time, you don't really have an option, but going forward, when you underwrite, you're going to pay attention to this, and you're going to try to project out larger increases than just, expense inflation at 3% or whatever it may be. The second one is not as big of a deal, but it's payroll costs. Good on-site staff is more challenging to find and more expensive. The second one is the slow eviction process in some jurisdictions. During COVID, there was roughly 1 year eviction ban. And during that time, landlords were still filing evictions, but nothing was getting done. People were trying to still stay in line. Some people decided not to and not file them. But so then what happened is, once that ban was lifted, the courts were backed up. And to further add to that, the sheriff's department that performs the evictions was short-staffed. So you have these two issues causing a backlog in some jurisdictions. And so it's taking much longer to get non-paying tenants out. And there are many tenants that are taking advantage of the situation because there's been, over the last couple of years, there's been plenty of help available. But that's still an issue that they're working through. And the last one, in terms of headwinds, is a recession, potentially a job loss recession. There's a path, and obviously the Fed is trying to achieve this soft landing where they get inflation down, and there's not a job loss recession. That remains to be seen if they can achieve that. But what we do know is that multifamily performs better than other property types, both during a recession and coming out of a recession, meaning that studies show that during recession, rents go down less, and they come out of the recession and hit pre-recession highs quicker than other property types. So it's really the most stable investment out there. And we think that these headwinds are things to be mindful of, but I think the tailwinds are much stronger. So, final thoughts. We are skeptical of a doomsday scenario across all multifamily. There's certainly a correction occurring for the reasons that I've laid out in the presentation. We think there's going to be pockets of distress, and most of those assets will need to be sold. So what we're trying to do, oops, let me go back, hit the wrong button. There we go. Is to be proactive, to seize any kind of upcoming opportunities that we see. Relationships matter. staying in constant contact with, our brokers that we use regularly. And then I put here, if you wait for the headlines to improve, you're most likely late to the party. See COVID. I think there are some similarities, between, comparing, where we are kind of now till for the next 12 months to COVID. Just so many people wait for complete certainty. And at that point, you're too late. And then you get hit with 11 rate hikes. And the last point is that our deals our deals and other people's deals, they don't represent the whole economy. They're local, smart, actionable opportunities that we think that we can execute, that'll set up our investors and us up for success and long-term returns. So that wraps up the presentation on the state of the market. If you haven't visited us on crownbaygroup.com, please do. If you're on our investor list, that's great. We'll be doing some more educational webinars, monthly newsletters, those sorts of things. And if you're not on our investor circle, please join, book a call, talk to me or to Steve, and you'll get on that list. So when we have a deal, you'll be first to know about it. So now I think I can see this chat box here. Okay, let's see if there's any questions. If anybody has any questions. Okay, we've got a question. Can you provide examples of value add strategies you've implemented in previous properties? In your experience, which ones have given the greatest NOI improvement? Great question. Yes. So first off, value add in the class B and C space, I believe, is different than in the kind of B plus space trying to take to an A level property. And because a lot of the tenants in the class, let's call it class C space, they want things like granite countertops, stainless steel appliances, all of these things, but they don't want to pay for it. So in our experience, it's doing more of the light upgrades that is the best bang for your buck. So obviously we do flooring, we do lighting, maybe it's 2-inch blinds. We'll do things on an as needed basis. We try to preserve as much as we can the life of the life of some of those fixtures. We will do, moving on to, I would say, we've done a washer and dryer rental program before, which was a really good one, where we bought washer and dryers and rented them out. It added about $1 million to the value of the property. So that's a good example. I would say for us, what we try to do first, and I mentioned this earlier though, is most of these properties have not been optimized, and they're backed up on maintenance, so they have a lot of turnover. So we just try to provide better management and be as financially aggressive as possible, but within reason. And we try to provide a place that is clean and safe, and we're responsive if tenants have issues. So that really goes a long way. But hopefully that answers your question. Okay, we have another question. Would you still do aggressive? Basically, would you still be aggressive in today's market on earnest money, going hard day one? If so, how would you get out during due diligence in case things don't look good? So basically what he's asking is, when the market was really hot, people would go put down earnest money deposit, and it would be hard day one, subject to certain carve outs. No, I do not think that is the case in this market. Now, granted, we haven't bought anything recently, but judging by the deals that we've looked at, it's much more buyer friendly. So I would not do that, and I would try to get, as obviously as long of a due diligence period as you can get. It's really just going to depend on the deal and how much interest there is in it. And you can, obviously talk to the broker and see what he thinks may work for the seller. Any other questions? Okay, are we doing on time? Oh, 7:44. Okay, so we're doing good on time. Well, if you do think of any questions, book a call with me. We have one more. All right, we'll fit you in. As he's typing this, but if you do have any questions that you think of after the presentation, feel free to email me. It's michael@crownbaygroup.com. You can schedule a call with us, and happy to talk. Okay, this question, it seems to me that the tenant base's ability to afford higher rents may reach a limit unless there's a substantial increase in incomes. I've come across pro formas that mention potential rent increases, but I find it challenging to validate these projections because it appears that rents may not be easily adjusted. How are you doing the underwriting here? Just staying super conservative. That's a really good question, because I mentioned that there's a lot of these tailwinds for multifamily. There's the supply has not been added to the market, so there's an ability to push rents. But you do have to keep in mind incomes and their ability to afford those rents. We have not, by and large, we have not had an issue getting rent increases at our properties. It has been somewhat surprising, but I think it's important to look at the demographics in the surrounding kind of 1 to 3, maybe 3 to 5 mile radius, and look at those median incomes and see what that percentage is compared to those incomes. And obviously, yes, I would try to err on the more conservative side, because you don't want to project rents that you can't achieve. I would also, obviously look at your competitive set. Are there properties around your area? Are they getting those rents, or are you going to be well above everybody else? So I would look at those things, and then, obviously I would get with a property management company as well as experience in that area and get their thoughts. Because ultimately you don't want to shoot for the stars and then you don't get there. And that's another reason why I say that a lot of groups I see that get into the BC space, they over improve their properties and then they try to charge extravagant rents, and they don't achieve them. We like to buy those properties because now they've renovated them, but it's dangerous. You're welcome. Well, great. Well, that's it's been about 45 minutes here. It doesn't look like there are any questions. So thank you very much for your time. I really appreciate it, and hopefully we connect soon. Thank you.